Interest rates have been low since 2008, and what this means is in the long term, returns are going to be lower. So the only thing as an investor you can control is costs. When you're looking at returns, about 90% of the returns come from the asset mix and only about 10% come from the securities you select. So why would you put all those costs in active investing when you can invest really cheaply in passive? I think firstly I'd like to dispel a myth, which is, people talk about passive and active being at a tipping point. When people are looking at the stats, they're only looking at the amount in funds. When you look at pension funds, private investors, insurance firms, we've got a much lower penetration of passive than we think. However, that doesn't mean that we can't get to a point where passive becomes too big. But what, in my view, will happen is, passive will give active a kick up the backside. It will make them lower their costs. It will make them think about the value of the ad and say passive is really the thing that's keeping the active industry in check. I think firstly with fixed income, again, there's a bit of a misnomer as to what passive fixed income is. When you have a passive corporate bond fund, they actually only buy about 25% of the securities in that ETF. Vanguard have more credit analysts than any active fund out there. So first of all, there is a process there. They're controlling liquidity. And then when we look at some of these active fixed income managers, they go out and they generate extra returns by buying securities that aren't in the benchmark, more illiquid bonds. So really the liquidity crisis could come in the active sector rather than the passive sector where they only buy the most liquid bonds out there. Active fund managers always like to point to this when it comes to passive. So they'll say, Vanguard own 5% of all the stocks in America and they don't do anything. The companies can do whatever they want. That's completely wrong. Passive investors are the investors that don't go away. When that CEO is trying to put his salary up and it comes to the shareholder meeting, the passive investors are the ones that are there year after year after year voting against those excesses. So whereas the active manager, if they don't like it, they just go away and the company can do what they want. The passive investor is the one that's really there kind of making sure the company is kept in check.